Money doesn't vanish. It just quietly escapes through the dumb decisions you pretend are investing. Fact 1. The future you will fix it. Investment trap. You know that feeling when you buy a stock, watch it tank 20%, and immediately think, yeah, future me will deal with that? Congratulations, you've just joined the universal cult of investors who outsource their financial disasters to a version of themselves that doesn't exist. This glitch is ancient. Humans are wired to think tomorrow will magically have more time, more discipline, more clarity. Basically, a better version of you who'll heroically fix the mess you created today. But here's the truth. Future. You has the exact same brain, the same excuses, and the same Netflix autoplay weakness as present you. So what do people do? They hold bad investments way too long because selling means admitting they were wrong, and your ego hates refunds. Instead of cutting losses, people wait for a miracle bounce that never comes, like a gambler whispering to a slot machine. Successful investors? They're brutally honest with themselves. They don't fantasize about magical turnarounds. They confront reality faster than their emotions can negotiate. You want to think like someone who actually wins in the long run? Delete the idea of future me will fix it. There is no future you. It's just you, making the same decision again tomorrow, unless you change today. Fact 2. The I'll wait for the perfect moment. Delusion. Here's the greatest self-sabotage mechanism in investing. Sitting on the sidelines like a philosopher waiting for the universe to send you a personalized invitation to act. People convince themselves they're being strategic, but really they're just scared. Scared to be wrong, scared to look stupid, scared to lose money they already mentally spent on a future yacht. So they wait for the mythical, perfect moment, a moment that has never existed in the entire history of markets. Meanwhile, the world keeps moving. Opportunities show up, say hi, and then disappear like they forgot your name. Markets rise, trends build, cycles turn, and you're still there, refreshing charts like you're watching weather forecasts for Mars. Real investors understand a simple truth: perfection isn't coming. You don't need perfect timing. You need consistent timing. You need a plan that ignores your emotional weather and executes even when your brain is screaming, "But what if today is the wrong day?" People who build wealth think in probabilities, not fantasies. They know hesitation is more expensive than mistakes. You can recover from a bad entry. You can't recover from never entering at all. The ones who win stop hunting for perfect conditions. They create their own momentum, while everyone else is still waiting for a sign from the heavens. Fact 3. The more information will save me. Overthinking. Spiral. Most beginners think they're one YouTube video away from becoming financial prophets. They binge charts, tweets, news alerts, macro predictions, moon cycle astrology, everything except actually making a decision. This is the investor's version of buying gym clothes instead of going to the gym. You feel productive, but nothing changes. Overthinkers believe that if they collect enough data points, they can eliminate uncertainty. But markets don't reward information. They reward execution. Here's the real punchline. People use research as camouflage for fear. The smarter they are, the better they get at inventing complex excuses to avoid risk. Meanwhile, confident, not necessarily smarter, investors take action, learn from reality, and adjust. Every successful entrepreneur knows momentum matters more than flawless planning. You grow by doing, not by hoarding PDFs like a financial dragon. The elite thinkers don't chase infinite knowledge. They define a system, test it, refine it, and run it. The amateurs drown in analysis paralysis until the only thing growing is their anxiety. If you want to level up, stop trying to predict the universe and start acting within it. Fact 4. The cheap means safe investment illusion. There's a magical belief among beginners that cheap stocks are safer than expensive ones, as if a $3 trash-tier biotech company is somehow less risky than a $400 share of a category leader. It's adorable, in a financially devastating way. People see low prices and think, well, it can't go much lower. Oh yes, it can. It can absolutely go to zero, and it doesn't even need your permission. This mindset is the spiritual cousin of buying clearance sushi. Technically affordable, emotionally tempting, statistically dangerous. Cheap investments are cheap for a reason, usually because the business is dying, the the management is clueless, or the product is so bad even the CEO uses a competitor. Meanwhile, the strongest companies stay expensive precisely because they keep winning. Pros don't ask, "Is this cheap?" They ask, "Is this valuable?" Big difference. Price is a number. Value is a direction. And if you want to think like someone who builds rockets, electric cars, or multi-billion-dollar businesses, you focus on trajectories, not discounts. Fact 5. The quick flip fantasy that turns smart people into clowns. Everyone wants to be the genius who buys something on Monday and sells it on Friday with a 3,000% gain. It's the same delusion that makes people microwave popcorn and then stare at it like alchemists waiting for gold. Short-term luck gets worshipped like a religion. People think they're tactical masterminds because one meme coin went up once. Here's the truth. Successful founders and investors learn early. If your strategy depends on luck, it's not a strategy. It's gambling dressed in a suit. The market doesn't care about your rush of dopamine or your dream of turning $100 into early retirement. People chase quick flips because patience feels slow, discipline feels boring, and long-term investing requires the one skill nobody wants to train: emotional endurance. The winners? They think in decades, not days. They build, accumulate, iterate, refine. They don't chase jackpots, they compound. And while everyone else is busy trying to catch lightning in a bottle, they quietly build the power plant. Fact 6. The confidence without competence. Catastrophe. There's a very specific type of investor who becomes dangerous the moment they make their first profit. One good trade, one lucky bounce, one green candle, and suddenly they're convinced they've transcended normal human intelligence. They start talking like they've unlocked the secret architecture of the universe. They quote statistics they don't understand, give friends unsolicited advice, and behave like they personally mentor billionaires in their free time. This confidence isn't built on skill, it's built on dopamine, and dopamine has never once produced a market genius. The elite thinkers, the ones who actually build rockets and empires, stay humble even when they win because they know randomness loves disguising itself as talent. Amateurs do the opposite. They mistake a lucky moment for permanent ability, and then they double down at the exact moment they should slow down. Competence is built through repetition, mistakes, and brutal honesty. Confidence is built through ego. One grows wealth, the other destroys it. If you want to evolve into someone exceptional, master your ignorance before you try mastering the market. Fact 7. The diversification means owning random stuff. Myth: people love the word diversification. They say it with the same confidence they order expensive coffee, like it automatically upgrades their IQ. But here's the secret. Most people don't diversify. They collect chaos. They buy a little crypto, a dead-end stock, a meme token, a real estate REIT they don't understand, and some startup equity they got peer-pressured into. That's not diversification. That's hoarding financial junk like a dragon allergic to organization. Real diversification isn't owning 10 different things. It's owning uncorrelated things. It's understanding risk clusters, macro cycles, market behavior, and how assets move together, or don't. True wealth builders don't scatter money everywhere hoping something sticks. They build a structured ecosystem where each asset has a clear job. The amateurs mix assets and prey. The pros engineer portfolios like machines. And when markets shake, guess which group sleeps like a baby? Exactly. The one that didn't diversify by accident. Fact 8. The emotional investment. Disaster. We all pretend isn't happening. Human beings are hilariously bad at separating money from emotion. We convince ourselves we're logical, rational, and analytical until a stock starts dropping, and suddenly we're bargaining with it like it's a pet. People hold losing investments because they feel loyal. They refuse to sell because they believe in the vision. They cling to a red portfolio because selling feels like admitting defeat. Spoiler: the market doesn't care about your feelings. Successful investors treat decisions like engineering problems. Data-driven, emotionless, brutally honest. If something breaks, they fix it. If something underperforms, they replace it. They don't attach their identity to an asset. They don't defend losing positions like they're sacred relics. They adapt. The amateurs? They let emotions drive the car while logic sits in the trunk with duct tape on its mouth. And they always crash in the same place, the point where feelings become more important than facts. If you want to rise into the top tier of thinkers, make one shift. Never let emotions manage your capital. Fact 9. The copying winners. Instead of becoming one syndrome. This is the biggest shortcut people take, and the most expensive. Instead of building their own judgment, investors copy the moves of people who seem smarter. They follow trending gurus, viral influencers, celebrity investors, and random Twitter prophets. It feels safe because someone else is thinking for you. But copying gives you zero context. You have no idea why they bought, when they'll sell, or what signals they're reading. You're basically a shadow of someone else's strategy, and shadows don't grow. The real players don't mimic. They observe patterns, extract principles, and develop their own frameworks. They focus on learning, not following. They understand that the goal isn't to act like the greats, it's to become someone others want to copy. Leaders make decisions. Followers wait for instructions. And every moment you spend copying someone else is a moment you're not becoming the person you're trying to imitate. Fact 10. The "if I ignore it, it can't hurt me" delusion. A shocking number of investors treat their portfolio like a dentist appointment. They avoid it until the pain is unbearable. They don't check balances, don't review performance, don't update strategies, because seeing the truth feels uncomfortable. But ignoring your finances doesn't freeze them in time. It accelerates the damage. Problems compound. Bad positions rot. Missed opportunities stack up like unread emails. People think avoidance protects them from stress. In reality, it multiplies it. The most successful builders, the ones who scale companies, innovate industries, and operate in chaos, face reality faster than everyone else. They'd rather confront an ugly truth today than a disaster 6 months from now. When you ignore your portfolio, you're basically saying, "I'd like my future self to suffer, please." And trust me, future you is already tired of cleaning up your mess. Face your numbers. They're not your enemy. They're the only thing that can save you. Fact 11. The chasing genius. Instead of mastery, trap investors worship genius. They romanticize brilliance. They think success comes from sudden insights, galaxy brain ideas, and moments of explosive clarity. They want to sound smart, look smart, be perceived as smart. But the people who actually win, they're not chasing genius. They're pursuing mastery. And mastery is boring, repetitive, structured, consistent. It's the unglamorous grind of making the right decision 1,000 times while the crowd gets distracted by shiny shortcuts. The amateurs jump from strategy to strategy like kids chasing fireflies. Momentum trading on Monday, value investing by Wednesday, crypto on Thursday, flipping NFTs on Friday. But every switch resets their skill back to zero. Masters build one system until it becomes second nature, then scale it. If you want to reach a level people call genius, you don't need explosive brilliance. You need relentless repetition in the same direction. Fact 12. The mistaking movement for progress. Problem. A lot of investors confuse activity with achievement. They check charts, open trading apps 10 times a day, join 5 Discord groups, watch endless market commentary, and think they're working. But busy is not the same as productive. A hamster runs miles every day and still lives in a plastic cage. Real progress comes from clarity, not constant motion. The elite thinkers, the ones building rockets, companies, and generational wealth, keep their systems simple. They focus on high-leverage decisions, not constant micro-adjustments. They understand that energy is finite. Every unnecessary action drains the power needed for meaningful moves. The amateurs feel productive because they're constantly reacting. The pros feel calm because they're always executing a plan. If you want to level up, reduce noise, increase intention, and stop confusing chaos with momentum. Fact 13. The trusting advice you didn't pay for. Mistake. Free advice is the most expensive thing in investing. Friends, coworkers, strangers online. Everyone has an opinion. Everyone knows the next big thing. Everyone claims they have insights. Wall Street doesn't want you to know. And beginners follow it because it feels friendly, harmless, and optimistic. But anyone giving free advice has zero consequences for being wrong. They suffer nothing if your money burns. They don't lose sleep if you lose years of progress. You're the only one who pays the price. Meanwhile, successful people founders, innovators, world-changing thinkers know that advice only has value when accountability exists. If someone has no skin in the game, their opinion is entertainment, not strategy. Before taking anyone's advice, ask one question. If this fails, do they lose anything? If the answer is no, the advice is noise. Fact 14. The expecting wealth without reinvention. Fantasy. This is the final and most brutal truth. Wealth doesn't come from doing what everyone else does. It doesn't come from comfort. It doesn't come from repeating the same thinking that keeps you stuck. Wealth demands reinvention of your habits, your mindset, your environment, and your identity. Most people want money without transformation. They want success while staying exactly who they are. That's not how evolution works. The people who break through, the ones who reshape industries, rewrite rules, and build futures, constantly upgrade themselves. They treat their identity like software. Outdated versions get replaced, bugs get fixed, new capabilities get installed. They don't cling to ego, nostalgia, or old patterns. They evolve faster than their excuses. If you want real wealth, you don't ask, "How do I make more money?" You ask, "Who do I need to become to deserve it?" That's the question that separates the stagnant from the unstoppable. Fact 15. The upgrading lifestyle before upgrading skills. Trap nothing destroys future wealth faster than present ego. The moment most people make a little money, they sprint to upgrade their lifestyle, not their competence. New phone, new car, new clothes, new everything. They reward themselves like they've conquered capitalism after earning their first semi-impressive paycheck. But here's the cosmic joke. Every dollar used to inflate your image is a dollar that could have multiplied quietly in the background. The people who win long-term do the opposite. They upgrade their skills first. Coding, leadership, investing frameworks, communication, systems thinking. Because skills compound harder than money. Skills raise your income ceiling. Skills turn opportunities into outcomes. Skills attract more resources than any luxury purchase ever will. Every wealthy person has a moment where they could have acted rich but chose to act smart instead. That decision becomes the foundation of everything that comes after. The question is, do you want to look wealthy today or be wealthy tomorrow? Because you don't get both in the beginning. Fact 16. The expecting growth without discomfort. Illusion. People crave improvement, as long as it doesn't hurt. They want returns without volatility, progress without pressure, clarity without confusion. But markets don't reward comfort. They reward resilience. Every cycle is designed to shake out the emotionally fragile. Volatility isn't a flaw. It's the price of admission. Beginners panic during downturns because they think discomfort signals danger. Experts stay calm because they know discomfort signals opportunity. Growth requires tension. Pressure builds capability. Discomfort forces reinvention. If you avoid it, you stay exactly where you are, gassed with the same fears, same mistakes, same tiny financial life. You don't become great by avoiding what scares you. You become great by expanding what you can endure. The ones who outperform aren't braver, they're better calibrated. They treat discomfort like data, not a threat. That's why they grow while others freeze. Fact 17. The waiting for permission to think big. Limitation. Most people invest small because they think small. They treat wealth like a lottery ticket instead of a system. They wait for someone to validate their ambitions, approve their ideas, or give them the emotional green light to take a real step forward. But no one is coming. No mentor, no guru, no market wizard is going to knock on your door and say, "Hey, it's your turn to build something massive." The people who become extraordinary don't wait for approval. They move as if they're already allowed. They give themselves permission to learn, to try, to fail, to iterate, to scale. Thinking small isn't humility. It's self-sabotage. And thinking big isn't arrogance. It's responsibility. You can't build a powerful financial life with a timid imagination. Your vision must expand before your wealth can. Fact 18. The never taking ownership. Wealth killer. This is the most important truth, the final boss of investing mistakes. Most people blame everything except themselves: the market, inflation, timing, luck, politics, bad signals, Mercury retrograde, their neighbor's cat, whatever. But as long as you outsource responsibility, you outsource your power. Ownership is the dividing line between people who rise and people who repeat. When you take ownership, every outcome becomes feedback. Every loss becomes information. Every mistake becomes a pivot point. Ownership transforms failures into fuel. Avoidance transforms them into anchors. The highest performers, the ones who build empires and rewire industries, take responsibility even when it feels unfair, especially when it feels unfair. That's why they progress faster than everyone else. They don't wait for conditions to improve. They improve themselves. If you want wealth, start where it actually begins, with the part of the system you control, you. So tell me, which mistake is draining your future the fastest? Admit it in the comments.